So yeah, things are going well.
Awesome. Are you going to pop into permissionless?
I am. I actually have a good fireside chat tomorrow with Jack Zamplin, the SVP of stablecoins at Ripple. We'll be talking about stablecoins, multi-chain adoption, all that good stuff.
Amazing, amazing. You going to be at ETC too?
I won't be at ECC. A lot of the Wormhole contributors will be though. We've got a few events and a few things to announce as usual, but need to pace myself because there's always another conference right around the corner.
They just don't stop. All right. Well, before we get into it, just a quick note: if you're hiring in crypto, just check out Campus. Out of all your candidates, it'll help you pick out the real crypto natives. Head to theblock.co/campus to get a 3-month free trial. Now, today's episode is about crypto going cross chain. So, Wormhole has seen a lot of growth in asset transfer volume, institutional integrations. What has been the main sort of driver behind this growth?
Yeah, I think so. If you think about maybe we take a 4 or 5 year step back, we very much so viewed the world, or maybe the consensus, main thought at the time was actually that everything was going to exist on one chain. Once upon a time in our journey of building Wormhole, that was kind of the school of thought we were up against. There was a lot of people that actually didn't believe that there was a need to connect multiple chains. They didn't believe that there would be multiple chains. It was a lot of specifically, everything will kind of settle to Ethereum. Um, and over the years, we've kind of seen that slowly evolve and become debunked. I think there was a period of time where it was like, well, there will be a fragmented multiple chain world, but it'll still all settle to Ethereum. And then now I think we're very, very much so in this period of time where, all right, there's going to be a lot of blockchains. Solana is, arguably one of the more used and popular ones right now. It's not even kind of all the focused on Ethereum. And there's other big ones like Sui coming up, obviously, Monad, there's Barachain, et cetera. So now we're kind of to this world where we are absolutely multi-chain. And so if you think about if you're an application, so you're a developer building something on chain, you are an asset, right? We have a lot of stable coins, we have a lot of institutions that issue something on chain. The funny thing about blockchains is you're beholden to kind of that ecosystem, right? The users, the apps, the liquidity of that one ecosystem. So that could be Solana, that could be Ethereum. You're only accessing one. You're deploying your contracts or whatever your logic is, and you're accessing like just one. And so if you really want to be successful and you want to open up whatever application or business or asset you're developing on chain, the best way to get the largest market is to build or issue across all of these chains. And so what we're kind of seeing is this evolution of from over the past 4 or 5 years of, you know, everything's going to be on one chain. There's not going to be multiple to there's multiple, but it'll be on Ethereum. Now you know, there's multiple and there are all different types of virtual machines. And now we're starting to see more and more adoption, especially institutional, and they want to be on all the chains. I think like the last thing I'll say on this is the concept on chain should mean all the chains. Like I think some blockchains base, for instance, and this, we work closely with them. This is just something they will say, not an attack, but they'll say on chain meaning base. But I would push this a little further, meaning on chain should just mean you're across all the chains, or at least across some chains. And I think we're starting to see kind of that critical adoption on specifically needing to be across all these chains if you want to be successful in building something on blockchain.
And are you seeing any growth in any particular chains recently in terms of like people moving assets to that chain? I was curious about Hyperliquid. Like, I know people are starting to build projects there. If you're seeing sort of growth there.
Yeah, absolutely. I think Hyperliquid is the current darling or the new kid in high school, if you will. Not really new anymore, but it's definitely that moment in time where we're seeing a lot of activity on Hyperliquid. We actually are launching Hyperliquid, I believe, in the next week and a half. So we'll start to push a lot of flows towards Hyperliquid. But we still see a lot of flows on some of these like the main ones. And one thing I'll say too, Tim, is that there's a common misconception that like I sometimes I see like certain providers say 100 chains, 110 chains, and there's definitely that many, but the activity on-chain activity is actually I think like 95% or something like that, and this is kind of a finger in the air number, is across probably like the top 12 chains. It's very like 80-20, and so we see a lot of flows between Solana still, Arbitrum, Base, Sui, hyper liquid, of course, but it's kind of that, it remains that kind of like top 10, almost how some people would think about like the coin market cap top 10, is kind of the same with blockchain.
Are you seeing much activity on Sui? Like I'm starting to see people talk about it a little bit more recently, but I haven't really like used the ecosystem that much.
Yeah, I think so what we kind of monitor is we look at flows between blockchains, and with Sui in particular, we see a lot of flows there. I think they're probably, we did like a 2024 wrapped, and it's kind of like when everyone was doing the Spotify wrap thing. Sui was our top, that was top three. I think that, yeah, the third largest inflows of any chain. So meaning like users sending assets onto the chain to do, something on the chain, whatever it is. It could be DeFi, it could be some sort of game, etc. So just based on that, and this obviously was towards the end of last year, we still kind of seen the same behavior. We're definitely seeing inflows there. What it exactly is for, I think a more of an open question. But I know Sui's recently launched a lot of homegrown protocols, Walrus, DeepBook, et cetera, that have seen some success, launched their own tokens. And that's really when an ecosystem starts to hit that critical mass as well, right? Like a blockchain launches its own tokens, but when you go through that evolution of the DeFi apps built on that blockchain also launching tokens, it's this like positive flywheel. And Sui's kind of going through that moment right now. Solana obviously had that. Chain hasn't even gone through that, I would argue. So I think it's definitely a good time for Sui.
Yeah. And are there any like crypto apps you've been sort of playing around with recently that you found quite interesting?
Yeah, I think so. One thing I've been focusing on a lot, because this is a lot of where we found strong product market fit, is real world assets. We say real world assets, we say institutions. I think maybe what does that mean? A lot of it is tokenizing securities today. A lot of it's money markets in particular. Um, I have recently, taken a position with private credit. We can maybe get into this in a little bit, but I think private credit on chain is like a meaningful use case that blockchain or tokenization can provide that you couldn't get with maybe in a traditional market. So I tokenized some private credit, and then I've just been toying around with the experience is to go from this KYC tokenization protocol. So I did this via Securitize. We work closely with them, to then using it in a money market on chain. And so I kind of went through the end-to-end process of effectively just looping my position. So doing this on Morpho on Polygon, actually. Shout out to that team. And it's obviously looping on a money market is nothing new, but I think just the novelty or the using an actual RWA I thought was something I wanted to try, because you don't actually see it that much, right? We talk a lot about tokenization, and it's happening. I think tokenization AUM is probably around 30, or like TVL is probably like 30 billion on chain today. So it's definitely gone up. But seeing it in DeFi, I think, is still where that next kind of catalyst or next wave is happening. So there's only a few select use cases for tokenization in DeFi today, actually. So that's mainly what I've been focused on. It's still a pretty clunky process, but it does ultimately work. But it's a lot of like someone's manually managing the position, et cetera. So I've been focused a lot on that, kind of the actual intersection of these like tokenized securities and using them in DeFi.
Okay. And why would someone want to tokenize their credit? Like, what are the advantages there?
Yeah, I think when it comes to the asset class of private credit, it is an asset class that has been effectively, I'm going to use some, just in this use spirit of time, like I'm going to use some broad strokes, effectively been gated for very high net worth individuals. So it's an asset class, if you wanted to invest in, usually involves maybe some sort of lockup, but in return you get some sort of higher yield, of course, risk adjusted, et cetera, et cetera. But the way in which you get access to typically like a private credit investment, some big private credit funds are like Apollo, Hamilton Lane. I believe KKR has a big private credit fund too. The way you kind of get access is, first you need some sort of like broker, right? Like financial manager. There's usually minimums involved there, right? So first of all you have to be able to get the financial advisor or the what have you in order to be able to buy this asset vehicle. So there's lots of different minimums, lots of different requirements for all these different brokers, but there is some sort of minimum, right? So that all instantly gates some people. And then to actually invest in the asset vehicle itself, there's also a minimum there. A minimum could be $500,000. I think that's actually like pretty normal, right? And so then you probably take out the majority of the population with that. And so when you think about bringing something on chain and being able to kind of fractionalize it, and have kind of offer these secondary markets, more liquidity, et cetera, you open up kind of the TAM of investor class that can invest in this. And so I think we talk a lot about over the years with crypto of like democratizing finance. I think it makes a lot of sense for stablecoins. We've done a good job, right? We're like exporting the power of the dollar to certain countries where people get paid something and the value of their money between paychecks goes down 15%. Like that's insane. So like there is a cool democratizing of finance that's happening with stablecoins. I don't think anyone's arguing with that at this point. But I think private credit's also interesting too, because this investment that, we always hear the terms the rich get richer. These investments that like these high net worth individuals have access to and maybe others don't, we kind of open up the TAM there. And so, you could buy Apollo private credit or Hamilton Lane private credit, I think is $10,000 now. So we went from a broker and $500,000 to $10,000. So there's still a minimum, but like, come on, that's gone down significantly. And so that to me is pretty exciting. And I think kind of helps deliver on some of these like promises we talk about so much with crypto and blockchain.
Sure thing. And what is Wormhole doing in the tokenized equities or sort of real WA space?
Yeah, absolutely. So we are effectively moving all these assets between the chains. And why is that important? There's kind of two reasons. Number one, what fund managers, talking a little bit more specifically, we say institutions, a lot of them today are these large fund managers. What they want is, they want assets under management to grow. So they want more people investing in the products. And so and this is the first bucket, they actually view crypto now as an asset class, right? You have a lot of people that want to invest in things that are on chain or within this kind of crypto realm, if you will. And so when you think about, let's say I'm a fund and I'm issuing on one blockchain, I really like, yes, there's a lot of users that use multiple blockchains, but it's still pretty sticky. So if they're issuing on Solana, they're only getting access to those users or those investors as they view them. So they want like the 2.5 whatever trillion market cap market of crypto, not the like what's beholden to one blockchain. So we help make sure that any asset issued on chain can be on multiple blockchains. There is like some nuance in the sense that like the blockchains have to be approved and certain things have to be deployed on the other ones. But in general, we're expanding the TAM for them so more people can invest. So you can buy BIDL, let's say on Solana, but you can also buy it on Arbitrum, Aptos, Polygon, Ethereum, etc. The second bucket is this kind of going back to this DeFi concept. So if you, let's say, hold the majority of your assets on Ethereum for whatever reason, you have a multi-sig there, etc. But we know that DeFi apps, are different across multiple different blockchains. Athena's on Ethereum mainnet. There's Drifter on Solana. You wanted to use one of these DeFi protocols. Let's say I had, I don't know, $50,000 worth of BIDL on Ethereum. I wanted to long my BIDL on, or use it as collateral, let's say, not long it, use it as collateral on Drift on Solana. I could keep, let's say, 25,000 on Ethereum, and I could send 25,000 to Solana, and then I could take a position there. And this way you're not like having to sell it on the secondary market for cash and then going and buying it on Solana and buying BIDL, et cetera. So it makes the flow of funds much easier, reduces a lot of friction. But what the behavior we typically see is using those assets within DeFi protocols.
Okay, and it seems that institutional adoption seems to be quite a big role in your strategy. So what's your main sort of strategy there in terms of finding success with the institutions?
Yeah. I think one thing that we always try to do at Wormhole is try to be like as intellectually honest as possible in a space that's kind of mired with, or that has a tendency to not be. And I would say the second thing is making sure that the I'd say with institutions, we like to target the tokenization platforms today. But I think what I was trying to say was like we like to target real use cases. And so being honest about what those real use cases are, I think is something that is important to us. So I think we went through this period in like 2020, 2021 where we talked a lot about institutions. You guys, you probably remember this, Tim, where it was like the institutions are coming, the institutions are coming. Lo and behold, it actually didn't happen for a number of years after that. You could argue that like FTX kind of set us back as an industry, and that's probably why. I think that's an acceptable argument. But I think for us, we try to understand what are the real use cases today, and then target those. And the real use cases today are tokenizing kind of like pretty rudimentary like asset vehicles. So we talked about money markets, we talked about private credit, and so today the strategy is, you know, these tokenization platforms often act as like gatekeepers to the relationships of these institutions and also the way in which these institutions issue anything on chain. So we've done a lot of work with our close partner Securitize, who's I would say one of the leading tokenization platforms, and you know, making sure that they have good relationships with BlackRock, Apollo, et cetera. And then anything that they're issuing on chain, Wormholes being used. So I would say that's kind of like one of the overarching strategies. And then it's trying to figure out what actual value can a blockchain technology provide, and being honest, you can't fool these institutions, right? You can't just be like, oh, just do it, we'll announce it, we'll figure it out. Like, what actual tangible value can this technology provide, and then going to them with these use cases. And you know, we have a few things in the work there around, you know, on the weekend in traditional markets, let's say an institution has cash, but they want to make interest over the weekend, but the market's closed, so they can't buy anything. Like, how do we kind of set up an arbitrage where they are able to kind of invest in the crypto market, get that interest over the weekend, you know, something like that, right? Like bringing these kind of like interesting use cases where 24/7 markets or fractionalization or like these various things that a blockchain tech can offer, like actually benefits these institutions at mass. So I would say our strategy, maybe just to summarize, is like real use cases and being intellectually honest. Like these institutions appreciate that. They want tangible, here's, you know, the ROI, if you will. And then the second thing is working with tokenization platforms. Like that's still where we're at today, is still in this kind of like tokenization era. It has been coming for a while, but it really nothing was happening until the past year. And now focusing on what it looks like to then bring those RWAs into DeFi, right? We have 30 billion on chain. Let's get that into some DeFi protocols.
Would you say there's been a big difference in the openness and willingness of institutions to like talk to crypto projects like Wormhole? Like when did that change? When did it change? And sort of how much has it changed their approach?
Yeah, I would say absolutely. I don't want to give all the credit to this, and I think this is kind of like a cop out answer, but I do think that we can't underestimate like the U.S. in terms of like a world capital markets is it's pretty big, and so I think a lot of these institutions kind of have a no BS approach to they don't want to touch this unless there is some sort of regulatory clarity. So I think a lot of them have started to get more comfortable. A good example of this is after the Genius Act was passed, I think JP Morgan like announced that they were going to do something with the stablecoin, right? It's like as soon as there's clarity, these I think these guys are going to start getting in a big way, or they are starting to get in a big way. So I think we've seen a significantly bigger push since this clarity we had last November with the administration shift. I would say even before that, though, we kind of started to see more. For instance, BlackRock is obviously very involved with Securitize. You know, they're a large investor, so they were thinking of a thoughtful approach of how do we take this, you know, take advantage of this technology, but maybe not super directly, right? So like working closely with another provider that they're obviously on the cap table of. So I think that we're starting to see, like, we're not even starting to see it. They're here, right? They're here. The amount of banks and financial institutions that are tokenizing something, you'd be hard pressed, let me say this, to find some that haven't announced something like they most have. Okay, and you could say, okay, that's cool. That was like 2021, 2022 as well. I think you'd be, you know, I think you could find a lot of them, but a lot of them have actually issued something on chain, right? So like JP Morgan has issued stuff on chain. BlackRock, Apollo, Hamilton Lane, KKR, VanEck. Obviously there's many, like we have the Middle East cohort has as well. So I think we're beyond their coming to, we're to the point that they're here. I think we're just at that point again where it's like, what does it look like to actually use this in DeFi and really grow the pie? But if you look at the RWA, and I kind of associate this with institutional adoption, RWA.xyz is a really good resource for this. If you look at like RWAs on chain, it's just up and to the right, which I think is a good indicator of real adoption.
And how do you think all of this plays out over the next 12 months? Do you think it's just more and more companies, more and more projects, they just keep expanding?
I actually think we're kind of going through a little bit of a potentially consolidation period, and maybe not when it comes to institutions, but I would say when it comes to crypto protocols, to crypto native companies, and also these larger institutions coming into the space, looking at what can they purchase. I think Stripe's a great example of, we could call them an institution, right? But like whatever, they're a non-crypto native company that has a lot of success in kind of the traditional market or tech space. They've obviously made 2 large acquisitions, and we've seen Ripple obviously make large acquisitions. Hidden Road was a huge one. Coinbase is making some of these. So like, I think when it comes to crypto native companies, we're going to actually continue to see a lot of M&A. We're going to see crypto native companies buy crypto native companies. And I think we're also going to see non-crypto native companies buy crypto native companies and protocols potentially, like figuring out what that could potentially look like. So I would say as I think about kind of institutions coming in the space or kind of non-crypto native companies, I think M&A, it is happening. I think it'll continue to happen at a faster clip, right? If you think about the cycle of any sort of M&A deal, it's long. 3 months is best case scenario. 6 months is probably average for a deal cycle there. And then, probably some of them last, 12 months more. So like I thought this 6 months ago, but there's a lag. So I think you'll even start seeing more kind of landing as time goes on. And then the other thing is kind of back to what I've been saying is liquidity is king, right? And I think that what institutions offer is just more liquidity than we can ever imagine, our crypto or DeFi native minds. And so these protocols become more efficient typically with more liquidity. Offering something like BUIDL as collateral to mint a stablecoin, that's big, right? Because BUIDL as an asset could grow to billions, if not trillions. I mean, we're talking an asset manager that has 13.1 trillion under management. It's not too crazy to think of that, right? So I think those are kind of the two buckets. M&A, we'll definitely see more of it. We already have, so it's not that hard to take. And then just more of these assets in DeFi. I'm starting to see it week over week, day over day, and actually helping some of the institutions figure out how that these assets can be utilized within these protocols.
Yeah, M&A has definitely been quite a big trend. What do you think about IPOs? Like obviously Circle has caused quite a big splash, and now I think we're going to see a lot of demand for other companies to IPO.
Absolutely. I think here's one thing crypto companies do a really good job of, and it's chase narratives. So let's just remove fundamentals for a second, right? Or the reasons why. I think, not all the reasons, but one of the core ones, I think, is just that any sort of crypto company IPOing, Circle kind of kicked off this like beautiful window of success or likely success. So if you're thinking about like, hey, what's this sort of net new, how can I get some capital within the company, or like some sort of like net new motion to kind of, I don't know, get renewed eyeballs, get more capital, et cetera. An IPO is probably a good move, especially given Circle's, just did that. And then also IPOs on chain, I think a lot of people are talking about. Maybe some companies like crypto native companies that may be too small to actually IPO on a traditional market, could be pretty interesting for them to just IPO on chain. It could be media companies doing stuff like this. You could see that. I think it will be, in particular for me, I think that is like an interesting company segment. It's like the ones that can't launch a token because they don't have utility for the token within a protocol. They don't have a protocol potentially, but they're definitely crypto native. And I think like these media agencies are particularly interesting there. I think tokenization platforms could be very interesting for that. So I think we'll see some like on-chain native IPOs, meaning like they don't IPO like Circle did, but I also think we'll see more companies try to go the Coinbase Circle route as well.
Yeah. Can you explain more what you mean by an on-chain IPO? Like, is this like issuing like security tokens?
Exactly. Just doing that, issuing security tokens on chain. Because if you think about maybe the IPO process in the traditional sense, it's probably the like walled garden to making that happen is probably a little too high for some of these like small cap companies. But maybe the process of launching something on chain or IPOing on chain, via some sort of like tokenizing the securities, I think could be an interesting approach and open up like a window where these companies that couldn't IPO through this normal route can now. Maybe we change the acronym, right? Maybe it's not IPO on chain, but yeah, I think that could be an interesting route.
Yeah, it's definitely curious idea. How's the Wormhole governance setup been going?
Yeah, Wormhole took an interesting approach to governance. So we launched our token a little over a year now, and we actually net new built we built a net new governance protocol. And the idea was we talked to a lot of governance protocols like Tally. I think they're like one of the biggest ones on Ethereum. I think they run most protocol governance. One of the biggest issues they had was as multi-chain becomes more of a thing, right? So you have a native token, let's say for a protocol on Arbitrum, and people send it to all these different chains. You actually can't use it in governance when the token exists on that chain. And so governance participation in crypto, I think governance in general is this area of crypto that needs a lot of work. But one of the core problems is like, as you send these tokens to different chains, you can't use them in governance. So like we're already struggling with kind of governance being effective on chain. And then you add this additional friction layer as multi-chain becomes more and more of a thing, tokens go everywhere, it introduces more friction. So we said, hey, what if we built something, because our native token exists on all these different chains. So what if we built something where you could vote from any chain? And so we built multi-gov with Tally, where effectively you can send your token to whatever chain, have it on there, use it in DeFi, et cetera. And you can still vote with it on that chain. And this is all done in either the w.wormhole.com or the tally.xyz wormhole like governance tab. So it took us a while, candidly, Tim, to launch governance. And that's because we rebuilt a lot of the core primitives. And we also rebuilt a lot of the governance stuff on Solana. It was a little bit clunky. It wasn't what we needed. And so we spent a lot of time rebuilding some of the like core primitives for governance on Solana. So you could vote from EVM chains and Solana with multi-gov. So we rolled that out finally, I think a few months ago. We're on our third proposal now. The proposal is kind of getting grants together. But here's the thing is, maybe not to be too long-winded, but I have this thing about like crypto's going through its practical era. I think one of we're asking ourselves a few questions, right? One question is, how many validators do you really need to secure a network? Do you need to have thousands of permissionless validators across all these different geos? Can you have, 100? Can you have 13 like Hyperliquid? I actually don't know Hyperliquid's latest number, so don't quote me on it, but I know it's not a lot, right? We came from this world of like, tribally arguing this, right? Like saying Solana was centralized. You look at Solana and they have thousands of validators. And now we have protocols that are just like the darlings of crypto with 13. So I think that's one thing we're asking ourselves. And then the second thing I think we're asking ourselves is, how is governance the best thing for these protocols? And I absolutely think you need governance. That's not what I'm saying. But I think like how decentralized is the question. I think a good example is Jupiter recently, right? Jupiter has been coming under a little bit of fire because they put stuff like who they're hiring, those decisions through the governance process. And look, I don't know exactly all the details. There's a lot to follow in crypto, but I do know that they're catching a lot of fire for that, right? It just slowing them down. The leaders were having to focus and argue with people in the forums, right? And so I think for when you think about Wormholes governance, one thing is really important for me is I want to be thoughtful, making sure that it's decentralized, just like our protocol is decentralized. But I don't want to slow down, the development of the protocol. It's a competitive space, interoperability, and we need to be in a position where we can move fast and make decisions effectively in order to maintain our edge on the market.
So you don't think you'll ever be fully decentralized?
No, no, no. I'm not saying that at all. I think again, decentralization is a spectrum, unfortunately. I was in DC recently and talking about like this exact thing, decentralization, and I think some of the like leading discussions are actually trying to answer like what is decentralized. I think maybe some traditional definitions, I'm going to botch this, but are loosely around like no one controls over 20% of a like given decision or something like that, right? So you could translate that into crypto native speak to something like a five-party multi-sig is probably not okay, or at the bare minimum of okay, right? You have five people, that's maybe like each have 20% or something like that, right? So I think what I'm saying is I want to figure out what is sufficiently decentralized, but not so much so that we have a DAO that is lost in a quagmire of decision making, and doesn't actually slowly loses their edge on the market, right? That's what I'm worried about. So I think we will be decentralized. I think we will be sufficiently decentralized. I don't know, what exactly that will look like in the future. But if you go on today, we have a delegate system similar to Arbitrum, all these other blockchains. So like we're well on our way in terms of decentralization and decision making. I think I'm just kind of being actively cautious about what sort of decisions go to the DAO because I've seen it time and time again slow things down. And I've even seen token holders want this, right? Token holders in a project want there to be some sort of autonomy with the core people who are focused on it 24/7, want them to have some sort of autonomy with decision making to move faster and more efficiently. And again, I encourage folks to go to the Jupiter DAO. I don't think Jupiter did anything wrong, by the way. I think they just had some learnings along the way with like how much they decentralized and the decisions they probably pushed to token holders.
Do you think with the sort of changing regulatory environment in the US, projects are less worried about the need to be or appear decentralized, and that it's now sort of a bit less of a focus?
I think that it's definitely given projects the opportunity to take a breath and think about what is best. We kind of went from this era of sprinting to decentralization at all costs because people were literally scared. So you wanted to be able to sprint at the expense of, again, like you really have to think about the trade-offs. Like if you have to wait 2 weeks to make a decision versus making it in a day with a group of stakeholders who think about this all the time. Like that's a significant business trade-off. And that's what effectively happens within decentralized governance. And so I think that it's given a lot of projects the opportunity to like at least take a beat and not their decision-making process isn't decentralization at all costs, because if not, I will, could get in some sort of trouble, right? I could be the centralized party controlling things. It's gone from that maybe to like decentralization is important. It's a core primitive to crypto, and we want the protocol to be decentralized. We want governance to be decentralized, but we also want to win, and we want this protocol to be successful. And so maybe taking a little bit more time to understand what could be a more of a thoughtful governance process versus like, again, I really think we came from an era of just like sprinting to max decentralization and then like having to pick up the pieces along the way. And I think we're even starting to see this kind of more thoughtful approach to, everyone. It's what's interesting, what I found, especially going through this process myself, everyone in all the token holders, all people in crypto, the main thing they want from tokens is value accrual, but value accrual to flow back to the token. That is still something that is largely gated today, right? There's really not that many examples on chain of projects that are doing it. A lot of them will do buybacks and burns because that will kind of bring value to the protocol. I've reviewed a lot of these, and it doesn't really help the token price that much. And so a lot of them want buyback and then stream of revenue to these tokens. And so that's something that I think the regulatory shift could hopefully bring for token holders, because I think it's this like weird thing where token holders are asking for it, projects know it, but they're way too scared still to do that because they don't want their token to be a security. They don't want to pay this dividend, et cetera. And so that's something that I'm hoping we definitely don't have regulatory clarity on right now. That's something I'm hoping we will soon. But that's also when we think about like this shift, I think people are kind of positioning themselves to be ready for that. We're starting to see a lot of projects that are getting revenue. Revenue is now kind of like a narrative. Hey, we should get revenue. We should be revenue generating companies, and then they're positioning themselves to like bring the revenue in, hold in some sort of treasury, and then as soon as there's this clarity, I think we will really start to see flow to the tokens, and then you'll see a separation in protocols even more. You'll see the ones that are actually making money and that money's flowing to tokens and not. But right now we're at this weird period where everyone's trying to figure out hacks like buybacks and burns. Yeah, that's great, but it's definitely just a narrative pump still. It's not long-term value accrual. And even the narrative pump is going away, I would argue. I've seen a lot of people announce these buyback and burns, and it's very short-lived success. So I'm hoping, I think to answer your question, Tim, I definitely think it's this regulatory change has given protocol builders a break to figure out governance, and it's been good. And I think it's been needed, but I think if we want to figure out that value accrual and that flow to token holders, I think we need a little bit more safety there.
Do you think you could see Wormhole doing revenue share within the next 12 months?
We will be in the position to do it if it is okay to do. That's what I can say. Absolutely. So Wormhole today has multiple ways in which it can, value can be accrued, you could say. And we will have that value flowing to an on-chain treasury. And then as soon as we have clarity on what can be done, we of course, token holders are the number one focus for us. So absolutely, and especially token holders that participate in the governance process. So yeah.
Is there quite a bit of pressure to do that given the sort of historical price performance?
Um, I think there's a lot of pressure in general to just have like a longer term, like to start showing revenue, right? I think we're again, maybe I'll go back to this like broad brand of practical era, right? Maybe the third kind of prong here is that as this industry matures, there's going to be more expected of these protocols. No longer, I think, I think in the next 12 months, it'll be much harder to like launch a token and survive off kind of the token. You'll have to have a meaningful business model. You'll have to have revenue, and be able to kind of create this like flywheel, right? This important, this ecosystem within your protocol. And so I think beyond anything token related or price related, I think it's just something that's the natural progression for a company going through the phase that Wormhole is and at the stage Wormhole is, and a lot of other protocols for that matter that have kind of been around, surviving off the token, et cetera. So yeah, I think it's kind of this part of this practical era for crypto.
Cool. And where do you see Wormhole in the next in sort of 5 years' time?
Uh, Connecting every asset, app, institution, AI agent, and user on chain. I mean, that's like when we think about crypto, everyone talks about the UX needs to be better, blah blah blah. Like interoperability side of me say blah blah blah, but like people have been saying the UX, and it's just like these things get a little tiresome over time. But it's not that it's not true. It's definitely not great. But I think the interoperability is one of the biggest unlocks for this like UX thing. You were going to see front ends and applications definitely dominate, and then Wormhole's the actual connectivity layer behind all that, right? So like let's use Polymarket as an example. If Polymarket's on Polygon, but if I want to, let's say, and I'm not saying this is live today, but like let's say I want to have USDT from Tron, but I just connect a wallet. It doesn't matter that I have USDT from Tron. I place a prediction for 100 USDT. But Polymarket says, hey, we're on Polygon and we only accept 100 US or USDC on Polygon. Wormhole is the settlement for those stable coins, so all that can happen seamlessly. Today, if you wanted to place a prediction on Polymarket, which I'm using an example because it's obviously one of the leading applications for crypto, you would literally have to bridge over your USDC from a certain chain to Polygon and swap it into Polygon USDC, and then you place your bet. It would be an awful process, right? I think they've done a lot to make that better, by the way. But like the concept I'm showing is just like any asset, doesn't matter the wallet, and making sure all of this is kind of connected in the background to provide a unified experience. So like we are supporters of a Jupiter, supporters of a Polymarket, etc. So it's just like more assets, more institutions, more users, more apps, all of this. We're the connectivity layer, making everything seem like one chain is the best way to put it.
All right. It's quite the vision. That is all we have for today. I want to thank Robinson for joining this episode. And as a reminder, our newsroom works tirelessly to get you accurate, informed crypto news. If you want to stay ahead, read the blog. Thanks, and see you next
Thanks for
time.
having me.